For more on the market and stock picks with all the tariff uncertainty, let's go to Denis Taillefer. He's Senior Portfolio Manager at Caldwell Investment Management. Denis, thanks for joining us today.
Thanks for having me, Marilla.
All right, so a bit of a quieter day with the American markets closed. The TSX is moving up 200 points today. The TSX seems to be quite strong so far this year, and I'm wondering if you could think it can hold on to the gains. It's pushed past that 26,000 mark again.
Yeah, we kind of like the composition of the TSX market versus the U.S. market. I mean, you've seen in Europe, the European markets have done pretty well. They were big underperformers for a long time. Canadian market kind of trailed the U.S. as well over the years. But we kind of like some of the backdrop here. Last week, there was some executive orders in regards to the nuclear energy, and we've got some decent names there in Canada. But that whole mining, copper sector areas we think we are going into a longer term cycle, and gold as well. So we do have certain sectors that are overweight versus the U.S. And so the Canadian market has done pretty well, and we do think there's still some room to grow here.
Okay, so let's talk about earnings. We had TD Bank report last week. We've seen some other companies report more bank earnings to come this week. What's your take on what you're seeing, given the tariffs being sort of on and off?
Well, it's been actually, quite good, I'd say, overall. If you look at the U.S. market, the earnings reports, again, season was quite good, as well as here in Canada. The one thing we are seeing, though, is when you listen to the calls, a lot of I'd say your C-suite commentary is really more around a lot of the uncertainty. So we do think that uncertainty around the tariff talks, the tariff wars, the different regulatory changes, if they're going to happen or not, as well as the tax framework going forward. These are all unknowns, and just creates an environment that makes it very tough for corporations to invest in, to deploy their capital. So while the earnings have still been pretty good, it's the commentary that has us a little more concerned. And when you look at the earnings outlook as well for the year, we started the year, the growth outlook was 12 to 13% on your EPS earnings growth for the S&P 500 for the year. That's been cut in about half. So basically the market is now expecting closer to 6 or 7%. So the earnings expectations are coming down. There's a lot of uncertainty. And I think we might start to see that kind of maybe hit the numbers a little more over the next few quarters, because I think that impact of companies being delayed with capital investment decisions is really going to start to hit the bottom line here over the next few quarters.
What are you telling investors who are still trying to either put money in or look down the road and try and get through the uncertainty? How are you advising them, or what are you looking at for their investments?
Well, we never really try and advise clients on timing the market, but so the advice is always, if you have a large sum of money, you should be legging in. But having said that, the way we kind of position our portfolio right now is we've really tried to focus on areas that aren't bogged down so much by that uncertainty. So there are certain areas of the market that we're seeing some really good, strong capital deployment. When you think of the artificial intelligence trade, right? There's a lot of CapEx being spent there to build out the infrastructure. We also like the companies that are really starting to deploy those artificial intelligence additions to their software, right? So the agents and so forth to really drive that productivity in their software. And there's certain industries or a lot of industries are really tight from a labor standpoint. So productivity becomes a key focus on a go-forward basis, investment-wise. So we look for areas like that, and just other sectors that just have very little exposure to the tariff dynamic. As long as we have this uncertainty, uncertainty is really kind of a killer when it comes to investments, and it just makes it really hard for stocks to do very well under a blanket of uncertainty. So we try and look for companies and sectors that don't really have that headwind, that can do well no matter what the environment kind of throws at them here. So that's kind of where we've been focused in our search for good investments.
You mentioned sort of automation solutions as part of that. What about health? Is health something you're looking at as well?
So, healthcare is definitely an area we kind of like. It's not very economically sensitive. Having said that, if you look at the U.S. healthcare sector, a lot of them have been caught in the crossroads of different regulatory type headwinds and so forth. Even areas you thought that'd be pretty safe, just the fact that the administration's been going after a lot of the universities. If you cut funding to universities, that cuts the R&D spend from these universities, and some of the healthcare names caught in that in those types of sectors have suffered a bit. So again, it really comes down to looking at specific names, what drives the name, and try to make sure we kind of try and avoid some of the areas that are higher risk from an uncertainty standpoint. So in Canada, we do have a small name that we really like. We think the healthcare system in Canada is really far behind when it comes to digitization. So we've taken some positions in that kind of market where we think there's very little regulatory risk, very little tariff risk, and it's really more a question of very large opportunities and very early innings in that process.
What's the name that you like in that sector, digitization for health data?
Yeah, so Well Health Technologies is a small technology name, healthcare name. So they basically have software that basically helps these small private, or not private, but these small physician offices, so primary health or specialty care type medical centers, right? So they basically have a software that really helps to digitize and make the administrative side of that business much more efficient. So as well, they're the largest owner of primary care offices. They have about 200 medical offices that they own and operate. They also have a big U.S. division. The U.S. division is actually a little larger than the Canadian division. But the U.S. division, the U.S. market, while still growing and a lot of opportunities, is fairly consolidated. About 55% of the market is consolidated. The Canadian market is not. Canadian, only about 2% of the market is consolidated. Well Health is the largest player in that, and they're about 1% of the market. So the opportunity in the Canadian market is significant. The return on investment capital is significant as well. So they're looking to divest their U.S. divisions, and they're going to reinvest that capital in what we think is a much larger opportunity and much better returns. So it's a catalyst-rich type story, but really at the core of it is really, again, digitizing that whole administrative portion of a doctor's business and stripping out the costs out of that. So they've got a real high uptake from doctors wanting to kind of join their ranks, and they get really good returns on that business.
Got it. Let's talk about Northwest Company, which is a retailer in the northern part of the country. Why do you like them?
So we like them because they really have a really strong moat. Retailing is a very tough business, very competitive, but they're really in those very remote areas. The company originated in '87, I believe, where they bought a bunch of several of the northern kind of remote stores that the old Hudson Bay Company used to have. So a lot of these stores have been in these communities for well over 100 years. And there's really not much more there from a competitive standpoint. Really, the business is much more, the complexity of business is really the supply chain, the logistics of being able to supply and run these stores. And they're vertically integrated. They have their own fleet of planes. And so they're really one of the very few players in town. They've got very small competitors, mom and pop shops, but they're the big player. And so they really dominate. And they basically serve the community in that they sell just about everything from your basic goods, your food, your pharmacy type services, to your discretionary spend. So your clothing, your furniture, your motorized vehicles, electronic goods, everything you need, you pretty much will end up buying in these stores. So we really like them because they've got that really strong competitive moat. So it really allows them to have really good margins in that market they operate in.
Got it. All right. I do have to leave it there. Denis, appreciate you joining us. Denis Taillefer, Senior Portfolio Manager at Caldwell Investment Management.